All right. Well, let me say hello. Hello and welcome to each and every one of you to the State of the Market in 2020 webinar. Man, I'm glad to see you guys. And I'll tell you what, I'm excited, man. I am excited about doing this webinar because I've been wanting to do this webinar for a long time, but there's no better time than the present. What I've seen over the last couple of years just confirmed my suspicions, let's say, just confirmed my theories. And I want to share that with you guys because going forward, I think this information I'm talking about is not only going to be interesting, it's not only going to be eye-opening, but I think it's going to be a necessity for you to grow as a trader or just an active investor if you're really, truly interested in making money. So thanks again for you guys showing up. Now, before I get started, I do quickly want to do the technology check, which you should see on your screen, the slide that says, welcome to the state of the market in 2020. You should see that slide right now. And you also should hear my voice. If my voice or the audio is choppy, or you can't see the screen, or it's blurry, or whatever it might be, just do me a favor and type that into the chat box right now. We'll see what we can do to get you set up so you can enjoy the webinar. And for those of you that can, if you could possibly just type in Y. That way I know that you can see it, the letter Y. Not why are you here? Just the letter Y. Type that into the chat box, and that lets us know that you're doing okay and we're ready to get started. I'll tell you what, like I said, I'm excited, man. I'm on my 5th pint of coffee here. I've thought about this webinar forever. So let's just get going. Now, also, I don't know how you guys found out about this webinar. Whether it was through social media, through email, through some sort of an ad, but if you are active on social media, here are my social media links. I'm constantly posting trade ideas in real time, charts, educational material. I do that both very actively on Twitter and Facebook. So I'm at the Lincoln List is my handle on both of those. Now, Instagram, I put it on there. I don't quite do the same there. I try to post pictures that make me look like I'm an exciting guy. But I'm just not. I'm just not an exciting, interesting guy. But if you want to follow me, there's my Instagram handle. Now, I know I see a lot of people in this room. You've been to past webinars. I see a lot of people in this room that I trade with on a daily basis in our live trade room. But of course, there's always quite a few new people that are meeting me for the first time. And I'm not going to go into my full history as a trader, but just let me formally introduce myself to those of you that don't know me. My name is Doug Rumer. I'm a 21-year trading veteran. I'm the lead trader and the founder of the LincolnList.com. It's a fully interactive trading community. And I also have a website there that posts trade ideas, a blog, and we have happy hours, whiteboards, and a whole bunch of educational materials, even free DVDs. So no matter what level of education you're looking for, you will find it at the LincolnList.com. Don't be fooled by the picture. I don't really look that refreshed and charming in real life. I tell you, I'm looking at this picture and I'm kind of stunned. I don't know who put it there. I'm like, where'd you get that picture? But that's like good lighting, forest lighting. But thank the outdoors, nature, and forest. So again, good to see you guys here at today's webinar. Now, something that I want to talk about, and the core of this webinar, is something you're going to hear me call the human element. And I think this is really, really important for all of us to understand what this is. I'm going to go into this in full detail, but this is going to be the majority of the topic that I talk about today is the human element in the market. Now, I'm also going to spend some time on how we're going to adjust to this human element or this new thing that I'm seeing in the market. Again, like I said, I've been here for 21 years, and I think what we've seen over the last couple of years, you can start to see the writing is on the wall. There's this really sharp, pivotal twist that's happening right now in front of us. And that's why I feel this is one of the most important webinars I've ever given. And of course, what are our best moves here for 2020? Where should we put our money? What should we expect out of this market? What are going to be the hot sectors? We'll spend a little bit of time talking about that. So let me get started here. What is this human element? What am I talking about when I say human element? Well, there still is, I put used to be a time, well, there still is a time, but it's less prevalent than it is now. When a trader, a professional investor could capitalize or recognize clearly beyond the shadow of a doubt who was on the other side of a trade. So to explain that better, you would often look just as early as 2 years ago. You could see a way a chart would move and the sequence and the speed, and you would know who was in that. Like, you would say to yourself, hey, that stock's too high for any real professional. any real money manager, any real person of consistent profit, money, power, or logic, or whatever, they would not in their right mind buy, short, or do whatever at that level. They just simply would not do it. A professional trader wouldn't buy there. They wouldn't sell there either. Now that goes a long way in a trader's profits. That's a big piece of profits, because many of us who have grown up in the market, like I started in 99. I didn't grow up like when I was born, but I really started at the beginning of the online revolution into trading. We learned these tricks and tactics. That's how we made the most of our money, is capitalizing on fear and emotions and euphoria from other traders. Now, it's a sad thing when you really think about it, obviously. I mean, but this is the industry that we are in. And it's like the saying goes, trading is a zero-sum game. If you made money, then someone else lost money. And unfortunately, it has to be that way. So you always kind of knew who was on the other side of the trade. And you were able to time their behaviors, to think about their behaviors, and to know, like I said, who's on the other side of the trade. But now, most of this trading that we are seeing is done by algos. Now, that's slang for algorithmic programs. If some of you out there watching this webinar, you don't really know what that is, that's computerized trading. Now, this is something that's been around for a long, long time. It's just not like 2019 was the first year of computerized trading. It's been that way. But what's happening is the balance of power between the human being trading and the computerized algorithmic trading has never been at such an insignificant, just a large discrepancy, such a large discrepancy. In fact, there was a recent study by the Wall Street Journal that estimated that less than a tenth of all daily stock transactions that you see come from retail traders. The rest of these trades are made up either by institutions, HFT, high frequency traders, basically computers. So to make this easier for all of us so we can follow along with what I'm talking about, 90% of every transaction that you're seeing in the stock market does not come from an actual physical human being. It's all done by computers. So now you may ask, why is this such a big deal? Or why does this matter? And why is this important for me to share this with you guys and talk about something that I feel is like a very pivotal moment in the history of the market? Well, the biggest reason is that a computer does not have emotion. Now, I talked about the human element. There's a time when you really knew you could take advantage of fear, greed, euphoria, sadness, anger, you just knew and you could capitalize on that. But a computer doesn't have any emotion. It's just simply going to do whatever it is programmed to do, and it will continue to do that until someone turns it off. It'll just keep doing it. It does not know. So it doesn't know if it's overpaying for a security. It doesn't know. It doesn't care, because it's not a person. It doesn't have any feelings. It's just programmed to do whatever it wants to do. It doesn't know if it's overselling something either. It's just doing what it's programmed to do. So you can kind of see where this is going is that for many, many years, human beings, human emotions, those things dominated the way stocks would trade. And stocks had specific behaviors to them because people with specific behaviors traded those stocks. And I always used to say this, that, we don't trade stocks. We trade people. And if you knew people and you knew how people reacted to FOMO, fear of missing out, you knew how people reacted to fear in general, you knew how people chased and had euphoria, you made a handsome, comfortable, profitable living, and it was a simple way to do it in its purest fashion. As you can see, computerized programs remove that from the marketplace. Now, let me give you some examples of this and where I'm coming up with this theory, because I know I can be crazy at times. I can say some things you're like, huh? But I got some data to back this up. This is a chart, a daily chart of Tesla. Now, I'm not here to debate what Tesla is worth, what someone thinks about Tesla. I am a trader. I look for value and I look for the best opportunities. Now, if you've ever studied trading for 2 minutes and read a technical analysis book, and practically, I would say even if you didn't know anything about trading, just looking at this chart would scream, it's overbought. This is ridiculous move. And these are the type of the moves we have not seen in probably since 1999. We just haven't seen this type of behavior. So when you're looking at these abrupt shifts in behavior in stocks in the market, you're looking for answers like, where's this behavior coming from? So a lot of people would look at this right now and say, who is buying this up here? Well, the answer isn't who, it's not a person. Because just about any logical human being would realize that the risk versus the reward on a trade like this does not make sense. If you traded anywhere in the past 4 or 5 years ago, this does not make sense. And it's difficult for you to invest and to trade what does not make sense. So it's not a who, it is a computer, an algorithmic program. Because the algo does not see overbought. It does not see the problems that somebody may see. They don't read the Twitter, so to speak, and say, oh, I'm watching this person, and they say, Tesla's junk, I should short it. They don't have those emotions, and they don't change their mind because they're a computer. So that's why you're seeing this. Here's another example. These abrupt, out of nowhere, non-catalyst moves. Now, there's a joke, a running joke that's happened for many years, really since after the 2008 crisis, starting from 2009. You all heard this lingo, I'm sure. BTFD, buy the dip. The joke about the 330 ramp, how the market ramps up into the close. Now, these started out as jokes, but they became more than that. This is something just from the other day. I've got the Dow stock market chart. You'll see the same kind of behavior on the SPY or the NASDAQ and probably a dozen other stocks, if not more. Is that these time frames down here, by the way, just for your reference, this is Pacific Coast time. I'm in California, so this is 3 hours behind actual New York market time. But I just want you to focus from this point right here to this point right here. This is most of the day, and you'll see that the market itself on this day, this was just a few days ago, wasn't doing anything. Was not doing anything. All the news had been out, and it's just sitting there. Now, in years past, what a trader got accustomed to here is that you would normally get just two things that would happen in a case like this. Either the market would slightly fade as people took profit off and repositioned themselves for the next day, or it would just ride the day out right here where it was at. There wasn't a whole lot to talk about that late in the day. But then all of a sudden, as you see here, this market takes off from roughly 28,400 and drives itself 150 points right to the close nonstop with these enormously large candles. Now, again, if you're a trader, day trading, it's like if you missed it down here, it's the risk versus reward. Even though in this case you'd have made money, this is not what you're accustomed to. This doesn't make sense, okay? Now, in this particular case, this is a non-catalyst move. So in the past, the only way this would happen is through a catalyst. Some catalyst came out and it would hide like this, and it would make it do this. This is just a non-catalyst move. So as a trader that you've been doing this for a while, you're thinking with logic, the first thing you want to know is what's happening? What's happening? What's happening? Okay? This thing just runs up and runs up relentlessly, and you can't find anything, so you can't make sense of that move. You're starting to see more and more moves happen like this. They started out smaller. Now they're just becoming more exaggerated and more aggressive. Here's another example. Again, this is after hours, like late at night, 1, 2, 3, 4 o'clock in the morning. Here it's like 3 o'clock in the morning, and you see this 150 point drop followed by this 200 point reversal at 3 in the morning. So you ask yourself, who is up trading 3 in the morning? It isn't the who. It is the computers. It is the computers making these absurd moves at odd times, you know? at odd times. Now, I know you might think, okay, well, it's just a different time. The market's trading at a higher price, or there's more liquidity, or whatever you might come up with. But just to further prove this point as I move on to the next part of this, is that what we saw this year was something I struggle to find anything that replicates in the past. Actually, let's go back for the last 2 years. The most dominant headline that there was, the most ridiculous, unbelievable abuse of a headline ever. Do you guys know what I'm talking about? I'll give you all a second to think about it. I mean, it's easy if you've been trading, you already know. But it just solidifies every single thing I've been talking about. The trade war. The trade war. Now, if you're an active trader, you cannot count the times that the same ignorant trade talks are going well. China wants a deal, blah, 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 whatever. How many times that thing spurred several 100-point rallies out of nowhere? And I was like, you could understand the first time, the second time, but this thing, by far, 2 decades into this, by far, this dominates the same recycled headline. This was the theme of 2019. It just rallied every single time. Now, where this comes down to the human element is obvious. Even the most ignorant, slow-brained jagaloon would know on a 54th time, hey, you're messing with me. Hey, you're messing with me. Hey, you're messing with us. But an algo doesn't, because it has been programmed to capture those headlines prior to the public. And bam, they run these stocks up. And not only did it once, twice, 50 times, 1,000 at least, 1,000 times abused the same headline. And this is what I'm talking about. It's not a person. So when you're looking at stocks, you say it's overbought. Who would buy it? It isn't a person. When you're saying who would fall for the same ignorant headline 1,000 times in a row, it isn't a person. It's a computer. These computers are changing, have changed. It's not a past, present tense. It's past tense. They've been changing, and a future tense. They've changed the way the market behaves. And that's going to become important, because what we've grown to expect from the market, which I'll talk a little bit more here as we go along, about how market crashes, market corrections, market behavior. We've got to change the way we think about it, because it's not that way. So what we might think is overbought and ridiculous and stupid and silly and ignorant might not be silly, crazy, overbought, stupid, and ignorant, right? It may not be that way. And we've really got to change, and change quickly, because this is something that is overpowering. Like I said, there are less of us out there. We look like we're huge on Twitter, but we're not. We're a very small minority in the market. And most of us retail traders, we don't have enough money to do crap to a company. We can't make a stock move. We don't have that kind of money. Even the richest intraday traders don't have that kind of money. It takes mega bills to move this. So this is something that we all have to prepare for. So let me just spend a second and just give you a small education on where I think this comes from. Now, this is just coming from my 2 decades of experience. That's it. I'm not a scientist. I didn't do some formal study on this, but I've got this far for a reason, and I got this far because I've seen changes happen throughout those 2 decades. I've seen strategies change. I've seen my approach change. I've seen the way market business gets done. I've seen all of these change, and I recognize when I'm seeing something in front of me that we are in a very pivotal moment, and the landscape will change forever in the future. And that's something that we're going to have to get used to if we want to do it. So who started this? Like, who's responsible for this? That's easy. It's the Fed. And some of you might already know this. It's the Fed and the central banks. Now, all of this starts, in my opinion, it starts, at a very, to me, it's easy to see. Again, these are my opinions. To me, this all started in the 2008 financial crisis. I don't know if any of you were trading back then. And it was a much different time than it is now. But back then, the message that they sent during this time is that they would sell their soul to the devil if necessary to save the markets. Now, I'm sure most of you had history. You've seen a movie or two on this already. Now, for those of us that started like in 99, lucky for us, we got to experience two market corrections. We had the dot-com implosion, and then, of course, we had the credit crisis. Now, they were two different things. That was just overvaluing in '01, and people weren't prepared for that, and wealth was wiped out. But what we saw in 2008, to me, was the worst type of impact on the market. And that was because there was a specific time when there were certain banks you would go to and they were closed. Like you couldn't withdraw your money that day. That's how much panic was on the street. That's the type of stuff that causes like people to go down the street with shotguns and torches. That's a certain event. If people feel they can't get money out of the bank, or the money that they saved, they're never going to get it because the country's going to go upside down because banks are closed and these banks are going out of business. That ensues some serious types of panic. And it's that kind of stuff that changes society, like where people just start, going crazy and apocalyptic. But what the Fed did, as many of you know, just in a short thing, they came in there and they bailed out these banks. Now, what they did in that case is bailed out people that were committing crimes, and they knew it. Like they knew they were giving mortgages out to people that weren't going to pay them back. They knew they were packaging these securities and stuff like that and reselling them, and they knew they were bad investments. Not a single person went to jail for that. I don't think anybody was really ever fined for that. And then when they screw up, rather than being, obliterated with punishment like most people when they make a mistake, they were rewarded by having bailout money given to them. Now, why this changes the landscape, in my opinion, is there's two sides to it. You have the power people with all of the money, the majority of the money, the banks, the institutions, the Goldman Sachs, the JP Morgans. You have all of these people. They are just running wild right now. Like the gloves are off. They realize that they can create things, they can make up things, they can do whatever they want to do, and they will not even get a slap on the wrist if that. It's worth it. There's not any punishment. There's no ramifications that'll make them stop committing securities crimes, lying to the public, misusing funds. So they're free. They're free to romp, and if they do get caught, it's just going to be some fine that they can easily pay. More important thing about this talk is that the Fed realized they had tools. They came up with tools, cutting interest rates, injecting liquidity into the market. So basically what they did at this point was print money and then turn around and buy securities with it and inject that liquidity into the marketplace. So if you think about that, it's more sophisticated than that. But basically the theory behind this, or the example to this, is think about how your trading would change if you could just go to your Xerox copier, throw, a $100 bill in there, Xerox it off, 100, 200 times, and then put that in your brokerage account and trade. All right. Who cares if you lost? You lost more money. You just add to your position by Xerox copying more money. You need more money. You just print some more money. It's like Monopoly. It's almost like fake. It doesn't exist. It's just created out of thin air to support a system that people abused. And to me, this sent that message that, number one, there will never be a ultimate market collapse because they will save it. They will do whatever they have to do to save it. They proved it. That's where the whole slogan, too big to fail, came from. So they had no problems doing that. And of course, it sends the message that to the bigger houses, bigger funds, we can do whatever the hell we want. We're going to be fine. And this interference with the market, this interference does not allow the market to operate normally. It doesn't allow nature to take its course. So think of it as like hand feeding a starving wild animal. You're always told, don't do that. Let the food chain take care of that. Let natural selection take care of that, right? Let nature take care of that. Don't interfere with nature. It sets a bad example. The animal could keep coming back wanting food from you. They tell you not to do that because you're interfering with nature. But yet the Fed, the central banks, are interfering with the nature of the market. And again, it comes back to my original theory behind this. It takes the trader, the individual, us people, us here, regular, 9 to 5 trader, blue collar traders, we're out there just getting what we can get from this market. It takes us out of the game, and it makes what we do more challenging because we've lost that normality. It's been taken, what we've come and grown to know and understand and believe, and we've been learned and taught. It's gone. It's gone because the Fed has changed the game forever. And this is something now we are forced to adapt because we're not going to change the Fed. We don't have any power whatsoever. I've always said we're a victim to the market. We have to do that. We have to do that. So when you combine that with the fact that there's less than a tenth of any logical thinking normal human being, we're just outnumbered. We are, in the market, a minority, and a severe minority. Like I just said, we look like we're huge on Twitter, but we're small, real small. They probably read our tweets and giggle. And the Fed is the big stack bully in poker. That's what they are. They will dominate the table and bully people because they have the money and they can print the money and they have the power and they can lower the interest rates and they can inject liquidity. They can have the QE. They can do all of these manipulative tactics to intervene and not let the market take care of itself, not let natural market behavior take place. And this is where we are, guys. This is right here where we are today in a market that's dominated by Fed, that's dominated by the central bank, that has QE, injected liquidity in it, and the regular day trader, the regular investor is a small piece of that puzzle and has no bearing on how they're just going to dominate and continue to do the tactics that they've learned to do. Now, the best way to look at it is kind of like think of like one of the self-driving cars, right? Self-driving cars. Now, we know that's cool. Like, oh, that's self-driving cool. That's cool. I could like take a nap while I drive. But really, the theory behind all of this is if you have a self-driving car, what happens? That means there would never be a traffic jam again, right? Because there wouldn't be some bozo going down the freeway at 80 miles an hour, randomly slamming on their brakes because they thought they saw like a sock or a piece of trash on the sidewalk or the side of the road, right? You know how you're following somebody and they just lock their brakes for whatever, just because they're ignorant. You don't have that. The human element, right? The human element of you're driving too slow or you're driving too fast on the freeway, causing traffic backups, people not using turn signals, cutting in front of you, using the wrong off-ramp, changing their mind to get on the off-ramp, then slide back on the freeway. All of that human element and human error and human nature that you've gotten used to by driving a car is now taken out of your hands. It's out of your hands. So if that happens, there will be no accidents, no road fatalities, no crashes, and there'll be no need for like insurance or anything. It's like everything will be peaceful and calm and controlling. So this is what's happening with the Fed. If they can control it, they are the self-driving vehicle. If they can control it, they can control when it goes up. And more importantly, when does it go down? When does it go down, which we'll talk about. And, you know, just more evidence. Here's how this Ned Davis says, algos have ruined day trading. Now, I don't think he's ruined day trading, but what he's specifically saying that I highlighted, taking advantage of inefficiencies in the market, right? That's what I'm talking about. Inefficiencies, discrepancies, giving you that edge in the market. Algos compensate for most of them. So when a trader would look at something and say, I'm going to buy at support, algo buys it way before support and runs it up higher. It never makes it. It never makes it to where the trader actually wants it. And this has also led to this great exodus out of hedge funds. So you got all these hedge funds. There is a record year of hedge funds. Hedge funds in one of the most bullish, top 5 bullish markets of all time in the history since this thing has ever been open. More hedge funds go out of business. So just right there, you tell me if these hedge funds can't make money in the biggest bull market of all time, then what is this saying? The edge that these people have learned to take on the human element, it's gone, guys. It's gone. That's it. So you only have 2 choices. You quit or you figure out how to do it. And we're going to figure out how to do it because we ain't quitting. We don't do that kind of stuff here. Now, for a lot of you, you might say, well, you know, if the market always goes up, that's a good thing. You're going to make a lot of money. You should want the market to go up because you'll make a lot of money, you know. And maybe you think that's your strategy. I'm just going to buy on hold because the market's going to go up and up and up. But no, that's not really the case here. If the Fed and the central banks and, the powers that be, let's call them, because we see the pumping tweets every day. What happens? What happens when the algos decide, based on who runs them, that they no longer want to buy Tesla up 400 a share? When did they decide? Maybe something's like we saw in December, right, of 2018, where you got this epic market sell-off, right? This aggressively fast, hardcore sell-off. But at some point, we will come to that where they look at it and they say, look, we want lower prices. There's a big theory behind that as far as the credit crisis was concerned. It was a good way for rich people to buy cheap homes, and now they've accelerated in price. I don't know if that's the case, but if you can look at one side of the table and say they can make the market go up and manipulate the market to go higher whenever they want, then obviously the next question becomes, when do they say, I would like to see the market go down 25% so we can buy all these securities again and then run it back up to where it was before and we'll get even richer, right? So if these programs can buy relentlessly, then there isn't any reason that they couldn't sell. They just couldn't sell whenever they wanted to. And you may see something that's quick. And this is what we are seeing. I'll talk about this a little bit later, but the biggest part of this landscape that's changed is speed. When these things take off, they have some enormous, strong, abrupt, just crazy moves that don't make sense. So when you're looking at this chart from a little over a year ago, we had that big correction in December. It took 3 weeks. 3 weeks. The whole month of December annihilated the entire year. So we're not talking about something that can go on for the next 11 months and do this again at the end of this year and clean everyone out. And then look what happens. It snaps right back, right? It snaps right back almost just as violently as it went up. And this is not a human element. This is not a piece of human behavior. This is not how a human being acts, reacts, behaves, pays attention to things. This is not how it's done with a person. It's all algorithmic. So remember that as you move forward, you're going to see stuff like this more often. Out of nowhere, more abrupt, more expansive, strong moves. Now, this reminds me of something I couldn't quite figure out, though. I'm just using my trader memory, which could be off a decade or two, but that reminds me of this Goldman Sachs oil pump. It went around somewhere. I think it was between 2004 and 2006. Sorry, I couldn't figure it out. I tried to look it up online. I got tired. I couldn't figure it out, but it kind of reminds me of this. They were stockpiling oil in the mid-2000s, like just buying up refineries left and right, And the whole time, they were upgrading oil. And this is the time that oil went to like 100 a barrel or something like it. It just shot up. It was an insane time. It was like oil was like Bitcoin, is just going up every day. And they keep upgrading oil because they bought all of these reserves and refineries at really lower prices. So then they unload most of it. And then, of course, what do they do after that? They just turn around and downgrade oil, so they could buy it back at a lower price. It's obviously more sophisticated than that, but that's a roundabout way it happened. And yeah, nobody got fined. Nobody got fined for this. Nobody went to jail for this. This is what we're talking about. The gloves just come off with each passing year. And why would they stop, right? Why would they stop? So this is something that we've got to start thinking about. And what this means, guys, and why I'm doing the webinar. Because, I'm not sitting here complaining about this. I'm passionately talking about something that we're experiencing. Because we've got to change. And where we change, it starts right here. Old school technical analysis. That stuff we've been reading in books, the trend lines, the moving averages, the Fibonacci cycles. Those things are going to come obsolete. Now, support and resistance to some extent will always work. But these tactics that were a bread and butter of a trader are going to be less effective. Because you can probably, if you're an active trader now and you've been trading over the last 5 years, you probably noticed that the continuity of the market, the way this stuff, like I keep saying, behavior, the way that it's working, the way that it's moving, it's different now. we're seeing some wacky back and forth action sometimes. And this leads to things I call fake outs. If you guys are just new here, fake out is when you know what's going to happen, you're positioned correctly, but then you allow a move in the market to take you out, and then you obviously realize, oh crap, I made a really, really big mistake. So you're going to see more fake outs if you haven't already, because that rhythm, that continuity is going to be different. And this is what I've been saying. Your approach going forward, you will be less rewarded for your technical analysis prowess and your ability to read charts and draw lines and Fibonacci cycles and Elliott wave theories. You'll be more rewarded for your adaptability, how you will be able to sniff out and use your logic, like this is a computer trading. This is a computer right here, not a person. The quicker that you can figure that out, that's where you're going to make money. Those are the traders in 5 years from now that are going to be surviving. The ones that are still sitting here solely dependent on technical analysis only are going to be living a very meager existence. It's going to be a frustrating existence. You may make some money, but it's going to be a lot harder to do so. And that's not something that we're interested in, right? Trading should also be fun. It shouldn't be, every trade you make shouldn't be a matter of life and death to you psychologically. If it is, you're doing the wrong thing. It's not supposed to be that way. Yes, you're going to have losses. Yes, you're going to have bad days. But for the most part, your trading should just be calm. If it's not, you've got to reevaluate. So these are the things that we are going to have to do if we want to stay here. So now let me take a minute here and stop yodeling about that and just share with you how I think we all will need to adapt in the future. How can we get on the right side of these trades and do our best to predict where these algos are spending most of their time and how they're actually doing it. More importantly, how can you forecast this? We've got to start thinking like that, and we must recognize the pattern that I'm seeing that's coming from these algorithmic programs is enormous volume and obsessive accumulation. Now, something I won't be able to show you in the webinar is obviously speed. These things begin to ramp up with some sort of very aggressive, uncontrollable speed. And it gives you the feeling that that's probably not going to be sustainable. That's probably not going to last. But in turn, they just go higher. They just keep going up. And that's really the biggest change. Again, if you've been trading and you're looking at all these numbers and figures and technical analysis lines, and you see something that just flies right into resistance, your normal thought as a trader is that, hey, this thing will get rejected at resistance. Now, sometimes that happens, obviously. But a lot of time, more and more, we're just seeing it blow right through it and just continue to go and continue to go. And you're going to see something we talk about like U-shaped rallies, V-shaped rallies, these abrupt shift, quick changes in direction. And I'll show you a few charts. So let's take a look at this one here. This is the last couple of days of Apple intraday action. If you don't understand the charts, just so everybody's on the same page, excuse me, is that the black is the time the market is open. And this is when it's closed, and this is when it's open and closed, and gray is when it's closed. So I just want you to look at this real quick, everybody in here, for just an exercise. And I want you to tell me, do you see any sort of rhythmic pattern to this mess? Do you see anything that is continuing to happen that we've talked about, that you see? I'll give you a second to think about it, but just take a look at the chart and just see in your own mind there, or type it into the chat if you think you see something repetitive or specific behavior coming from this stock. So here I'll show you. Take a look at the aggressiveness that is coming from these ramps. This would be a ramp. So this thing takes off. It's like once it starts moving in a direction, it just does not stop. If it goes to resistance, it does not stop. It just doesn't stop. It just keeps on going, and it keeps on going, and it keeps on going. So you have this very aggressive start to the day. Then it just kind of slightly fades, and you have this, again, another aggressive move up. So when you're watching these in real time, they're not just sitting here melting away like a lot of people are saying. They're just taking off, and there is literally zero pullback. Like they don't even down tick a nickel on a $300 stock. Now, you had some news here over the evening about the bombing in Iran and all of that. This brings me to something I want to spend a second on, and that's talking about when they decide to sell. We might have saw a glimpse. We saw a glimpse, obviously, in December of 2018, but again, you kind of saw a glimpse of how strong and quickly the tempo could change. Now, there's a lot of complacency in this market. It doesn't take much. But you can see what happened here. This thing just is driven to mercy in the evening, right? And again, algos are just dominating, forcing panic, forcing euphoria in on the remaining physical traders. And then later on, the next day, you get this massive ramp. So this is how you're starting to see these programs in place. Everything is to the extreme. It's the expansion of normal range. Everything is expanded. So when they get on top of a stock, slang for just wanting a stock, they pick one a day and you'll see this absurd $20 rip on Netflix when the chart looks like it's dead in the water. You see Tesla, people just continue to being chased with programs. At some point, they'll stop buying it there. But this is an intraday viewpoint of how these things happen. It is the non-justifiable, abnormal, extremely expanded range move. That's what we're seeing. So when these things taking off, they are ignoring old school, customary chart patterns where you're saying you buy at support, you sell at resistance. It's like this thing blew through resistance right here like it was, hot butter or something, wet paper towel trying to hold back a cannonball. It just took off and it didn't stop. It didn't even take a breath. I mean, look at this thing, just straight up. And you had to shut the market off to stop the algos, and they start buying it after hours. This is what we're seeing. And again, this is on a stock that looks like this already. I mean, look at what has happened for the better part of the last few months, 6, 7 months. I don't think this thing has had a down week since August. I may be incorrect off of that, but I mean, just look at this type of stuff. And again, I showed you Tesla. I'm just bringing up to bring up to. You're going to go through charts and you're going to see a lot of it. You've seen things like Shop. You've seen Roku do this. So what I'm trying to say is that the logic, the common sense factor that has gotten retail traders by this far, utilizing those support resistance trend lines and all those other tactics with moving averages, that is starting to be removed. Now, while that may continue to work in different formats, the original basis behind that is becoming more and more invalid as time approaches. Because as you're looking at Apple, and this is not a debate about how much the company's worth and whether it's overpriced or underpriced or should be here or not. It's a simple fact that looking at a chart like this tells you that from an investment standpoint, your risk versus reward is hideous. So it doesn't make a great investment here. That doesn't mean you're not going to make money on it, but it makes a poor entry point for somebody that's just putting some money to work. This is not the best place, but it doesn't stop going up either. And that causes people, the remaining human beings, to FOMO or whatever, even these algos to chase it. It's just, this is not something that happens in a normal scenario run by a human being. Now, you might get a couple of these like a KBIO, a pump and dump and that stuff, but you wouldn't see so many. It's not just one. I showed you Tesla. I talked about Shop. I talked about Roku. I mean, you go down the list, you will find hundreds of these that have just had absurd runs. And these runs go so much farther and last so much stronger than anybody ever anticipates. Now, a lot of this could have something to do with tax cuts in the elite, putting more money to work, with all the tax cuts to the larger corporation doing buybacks. I mean, it's a whole different political topic there. But what we got to do from day one right here, starting from this point on as we're moving, we need to respect what it is that we are seeing. Because years ago, I would feast off of these as shorts. It was a mainstay of my business. And I learned real quickly in the later part of 2017, it's like, I'm not doing that anymore. Because what happened is they did not pull back. They used to pull back and you could make money that way. Now they just either keep going or they stop moving altogether. They very rarely allow you any second or third opportunity, even from the long side. This also takes the pressure for the breakout traders, momentum traders, or long traders, is that if you're looking to buy that break, you are normally buying stocks that have already gapped up, or you're buying longs that are already up 88 days in a row or some insane amount like that have already had big pieces of their range chewed up. And then if you don't catch those in those times in the morning, then you've missed probably the next opportunity, because when they're coming by, you're also starting to see these things are happening within the first hour and the last hour most of the day. So like when you're looking at this Apple, that's in the first hour. This is late in the day. This is the first couple of hours. That's when you're seeing these moves take place. It's not so much happening in the middle of the day, but still you will see them. But again, the whole point here is you're not going to see charts and stuff like this. So I think I've established here the impact and the way this landscape of trading has changed over 2 decades, how computerized has become, and it's taken some of the things that we've grown up on and the things that we've been taught and the things that you're probably being taught by listening to people buying DVDs now. Some of the stuff is going to become obsolete, and I'm not afraid to admit that. Say, look, this is a different time. So when we're talking about big movers, like what do we do now? Like what would be your next move? Where would you think your money should be put to work here? Are these stocks that you're looking at the best for your money? What should you do? I would say that anything is already up. Let's just say Tesla, Apple, and anybody that looks like that, Roku, shops. There's going to be trades there, and there can be short-term fluctuations in it. But if you're looking for investment money and you're looking for something outside of just scalping trades, if you're looking where the big money is going to come from next, at this stage of the game, being so early in the year, it's difficult to tell what sector is going to do the most performance. Last year was obviously technology, so I wouldn't expect technology to continue to lead the market. And I would see as more of these stocks continue to rise, the more the market flirts with all-time highs, you're going to see more money flow into precious metals, things like gold and silver. So you're going to watch those stocks. Gold has had a pretty decent rally, but you're probably going to see more money as the first quarter ends into the second quarter. After the earnings come by here in the next couple of weeks, you're probably going to see more money pile into those as a matter of mitigating risk. But what else I want to talk about is that the next big monster mover, the one that just stuns people, you don't even know about it. Maybe you do. Maybe you are watching it, you just don't know it yet. It isn't there. It isn't Apple. It isn't Tesla. It's somebody else. It's going to be the stock that takes off that traders don't believe and don't catch on to, like Roku. Every year since I've been doing this, there has always been a Roku. And like year before, there was like Twilio did the same thing, GoPro did the same thing, MCP did the same thing. I mean, all these stocks, every year there's a $20 to $30, $40 stock that just takes off and just never ever looks back. And you normally pick up this one not just based on, like you're looking at it like this is another area where the shift comes in, is I put traders will not believe it. And this is part of my theory behind all of this, is that we look at it, because I was one of the ones that looked at it, I'm like, I kind of like Roku. I thought it was overbought at 50. And I felt at times I was buying, like, I don't know, man, this thing's up like, awful lot over the last couple of weeks. It didn't stop till it was like 160 or some insane level like that. I think it was somewhere in the 160s. But there's going to be another one. There always is, regardless of what the market decides to do. It can tank. The thing that I've got highlighted there is not believe. And this is what we come down to when it comes to algorithmic programs and the human element. The human element, the human being, the person, us, at times we find this difficult to comprehend. We don't understand. And this is a tough thing for trading, because some people need, just their natural chemistry, they need to understand everything. And market is a hard concept to understand even before this. But it's that understanding. It's hard for a human being to look at this stuff and understand what's happening and to be okay with what is happening and try to adjust to what is happening. Because again, we've all been taught a certain way, or most of us have been taught a certain way. And if you've been trading as long as I have, it's like the way I started learning and what I've actually learned now are two separate things. And I'm seeing this shift now that the stuff we've been learning over the last few years is going to have to be changed again because the market has changed. And we don't need to quit. We don't need to be upset. We don't need to be depressed. You know, we can do the whole conspiracy theory and cry about it. You know, sometimes I curmudgeon and bitch about it, but I'm just naturally a curmudgeoner. That's what I do for a living. I complain about everything, and I'm honest about that. But, you know, we got to change. That's what we got to do. We've got to find a way that we can work along with it because, again, we don't have the money, we don't have the power, the strength to change any of it. We are just victims to the market, and if they want to pump the market, if the president wants to pump the market, if the Fed wants to pump the market, if the algos want to buy every trade war headline, we've just got to do the same thing. There's not much we're going to be able to do inside of that to counter-react that. We're just going to have to go along with the flow. So if you're looking for that next big sector, there's a few ideas that I have there. I don't think it's going to be technology. I think you're going to see precious metals and stuff like that be more of a topic this year. But we'll find this stock. I mean, most of us don't even know what it now. We can speculate and you can say, I think it's going to be this one. I think it's going to be this one. And if you've got something you think it is, then type it in. But I believe it's yet to be determined. You know, so when you look at something like a Roku, you know, at the beginning of the year, at February, it still really wasn't on a bunch of people's radar. Now, there was a lot of people trading it. I was even trading it back then. I even remember when NVIDIA, you know, when I first started the Lincoln Million program, we longed NVIDIA at $14. Yeah, $14, and now it's over 200. So that next gem that you're looking at, that next big winner isn't coming from something coming from NVIDIA now, or Netflix, or Apple, or Tesla. There'll be trades in there. There'll be swing momentum. There'll be chances to capture some alpha. Don't get me wrong. But if you're looking for that 400% runner, we get a few of those every year. This is where you're going to need to look. And that's take this Roku chart and print it. Look it up yourself. Print it and tape it. Somebody will have similar behavior. I saw Twilio do this, 35 into the 100s. I think I saw a bunch of other companies do this. But anyway, you see how it didn't start and then it gaps up on earnings, goes sideways, gaps up on earnings. So it wasn't until May really did this thing just charge. Yes, it was already up enough already, but it was really that May earnings. It didn't really, just that move from May all the way through the summer was so huge. So this thing did most of its damage to the upside between May and the later part of the summer. So the entire summer, it's like a six-figure summer trading this stock. And this is what you're going to be looking for. It will be the stock that simply refuses under every circumstance to die. And when I say every circumstance, Roku was downgraded, still went higher. Roku was lowered guidance by analysts, blew them right out of the water. Traders shorted it. They got smoked. The more disbelief, the more hatred, the more kicking and screaming and denial, the harder the run. And that's probably why you see something like Tesla where it is, because you're only on two sides of the fence there. You either hate the thing or love the thing. That's all there is to it. But as we move forward through this first and second quarter, these are the things that we need to look at right now. Where is our money best used? Like we're already trading against computers. We're going to continue to trade against computers. I don't think you're going to see the bullishness that you saw in 2019 repeat throughout this year. At some point, these FANG names, these larger stocks, they're going to want to peel back a little bit of these gains because the houses, the institutions, they're up on these. They don't want to just keep buying these at these high prices. You know, there's always a saying, the market will drive. I've used it before. The market will run up prices as high as it needs to make it unattractive, and then it'll sell off as much as it needs to do to become attractive again. It's the way it works. Eventually that'll happen if the Fed doesn't intervene. But keep your eye on this type of a pattern when it comes to Roku. This is something that you'll see here again, probably in a few names. Now, a lot of you asked me over the last 6 months, and especially leading up to this webinar, is there going to be a market correction? Like, this is the year the country slides into a recession and, we have a market correction. Now, I might be wrong with this statement, but, it is what it is. I feel now with the way that these algos are dominating the market, that any correction you do get I honestly starting to believe that that correction just will be computer engineered. It will be done on purpose. And it will be done to get the prices down, just like I said, to buy it all over again at a lower price. So they may be looking about, you know what, I'm tired of paying $480 for Tesla. I don't want to pay $480. Just imagine if we got it for $350. So let's just sell it all, run it to the $350, and then we'll buy it back again. I really believe that, you know. I also believe with the Fed's policies that they have in place, the way that this market, I wouldn't be surprised if we went into a recession and the market was still bullish. You know, the market was still bullish. Now, if you look historically at the market, I don't have a chart here, but even in the worst, bear markets don't last very long. They don't. They're just really impactful and do so much damage in a short period of time. I've done a video on this before. So like when I remember the dot-com meltdown, that only took place, the damage, from March of 01 till roughly the end of the year, right after 9/11. It was that period that did 95% of the damage. Then after that, you know, collected its thoughts and you started to see a bullish market. Even though we were kind of still considered bearish, it only lasted for a short period of time. Even the credit crisis, most of the damage was done throughout the summer of 08 into October of 08. After that, like the market hit a bottom early 09, like it had done most of its damage throughout that latter part through the summer and everything of 2008. And just like you saw with this, the correction that we had in December, it really just took place in 30 days. So these corrections that you see don't last years. We may be in multi-year bear markets, but the actual damage, the actual correction, when it comes next, it will be what many consider to be catastrophic. It will be big and it will be quick. So in these cases, you know, the best advice I would have is, you know, you don't need to be the first one to the party. It won't last long, but that's probably what you're going to see. And especially with algo programs, it could be vicious. And I think some of us might have even gotten a taste of that several years ago. If I'm recalling correctly, I don't know, it wasn't 2012, I don't know. I can't remember what year it was. 2012, I think. The flash crash, whenever the flash crash was. I mean, it was kind of the same thing. Algo program gone rogue, drops the market 1,000 points. Now, they probably fixed those things, but again, I guess we've all seen enough sci-fi movies to know what happens when computers take over. It might be like iRobot. They just turn on us and here we are. So think about these things going forward, guys. In a recap of this webinar, bounce around a little bit. I always talk like that. That's just my nature. But the human element is now being removed from the market. So the tricks, the tools, the tactics, the strategies that we learn, they don't necessarily need to be all thrown out, don't get me wrong. But we really need to think about these things first. We need to change some of the ways that we approach trading and investing. It's going to present its own set of challenges. It doesn't mean we can't overcome them. It doesn't mean we can't make more money with them. It doesn't mean we can't work through them. But we need to be aware of that. We can't expect that old school technical analysis and old school techniques are going to pay off in a new world. We just cannot do that. It's not really up to us to decide if there's going to be a market correction, you know, and how that correction is going to go, or if the market's going to go higher or lower. Remember, we just play what's in front of us. That's all we can do. We don't have the power to control that. We all need to know what our place is in this market and what we're trying to accomplish. We cannot change the things that are happening in front of us. We have no choice that if we want to make money, we have to coincide with what is happening. We have to make peace with that and treat it as if it's a relationship between us and the market. That's the only way we'll survive. And of course, the hot sectors, you know, I was thinking some gold here, but I really believe that it's yet to be determined. That next 300%er has yet to show its face. It's just like a little infant child or like a little raptor in Jurassic Park that just broke its head out of the egg and he's going, meh, meh, meh. He's going to grow up to be like the most vicious, evil, human hunting, carnivore killing raptor of all time. And he just like poked his head right through the egg. That's the stock. Just a raptor poking its head through the egg right now. We don't know it yet, but we'll find it. We always see it every year. I've seen these with Shop. I've seen it with Roku. I've seen it with Twilio. I've seen it with TTD. I've seen it with DEC before. I'll see it again. And what I haven't done in years past is taken full advantage of it when I've known what was going to happen. Now with understanding more about computers, computer trading, I'm more prepared. And I want you to be prepared so you guys can make some money. That's why I did this. Now, I'll tell you what. As I usually do in a lot of these webinars, I'd like for some of you guys to share some time with us and trade with us live. So what I'll do right now for anybody here, I'm going to offer you a 10-day free trial to the trade room. No credit card needed. You just send me an email to support@thelincolnlist.com. You type trial right in that subject line. I'll have you set up. So for some of you who don't know what that is, every day I trade live on screen, talk about my trades. It's all voiced, very much similar to the environment you're looking at now, except for you to see my charts. It's a great way to learn, share ideas, and help each other just get better and grow as traders. So if that's something that you're interested in, then go ahead and send it over. I'll be glad to. So if you're on your way out, I want to thank you for coming to this webinar. Like I said, I was really excited about giving it. I think this is a great topic. If you have any other tips, suggestions, just send them to me as well as support at the Lincoln List. Love to hear from you guys. For those that want to squaggle around here a little while, I'll be here. If you guys want to ask some questions, you want to shoot the BS off topic here, I'll just be sitting around here for the next half hour or so until the last person leaves. You want to talk stocks, you want to talk shop, you want to talk trades, you want to talk whatever, you want to talk about some more algo programs, share your stories with me. I'm here, so I'll open up the floor to any type of questions. For those that are leaving, thanks for coming by. Glad you enjoyed the webinar.